Bitcoin is about to start a generational price run. Last week, Bitcoin made a new all-time high, breaking through $124,000. But here's the crazy part. Top metrics and indicators are still sitting in the mid-cycle zone, nowhere overheated. Signals currently show that we're nowhere near the end of a bull run. In fact, we're still in the middle, where massive jumps usually happen. This moment could mark the beginning of Bitcoin's next bull run, unlike anything the market has ever seen. In this video, I'm going to show you why every signal is flashing higher, and as we move through it, I'll be bringing in the voices of Saylor and Saifedean Ammous. Saylor is the man who transformed MicroStrategy into the largest corporate holder of Bitcoin on the planet. Ammous is the economist behind the Bitcoin Standard, where he makes the case that Bitcoin is on its way to capture the $300 trillion global money market. Here's the truth about what's currently going on. No single chart tells the whole story. What matters is when many signs point in the same direction, and right now, that's exactly where we are. ETFs are hoarding supply, corporations are stacking Bitcoin on their balance sheets, and the blockchain itself is flashing signals that this rally has only just begun. All the pieces are in place, so let's break it down and see where Bitcoin's next move could be its most explosive. And before we jump into it, just a quick reminder, only a small percentage of you watching are actually subscribed. If you're getting value from the videos, hit that subscribe button. It's free, it supports the channel, and you can always change your mind later. Now, let's dive in. First things first, we need to talk about the corporate Bitcoin treasuries. They are stacking Bitcoin faster than ever. Boardrooms and CFOs are waking up to the reality that cash is melting, while Bitcoin stands as the best balance sheet asset that's immune to inflation. Saylor proved it with MicroStrategy. He raised capital, Bitcoin, and held on. It looked reckless at first, but it ended up boosting the company's performance and driving its stock sharply higher. That result turned heads, and now other corporations are following the same path. Each time a company adds Bitcoin and performs better, the pressure builds on competitors to do the same. After all, no board wants to look behind the curve, and no investor wants to watch their cash lose value while others grow their wealth through Bitcoin. The latest example of companies following the Bitcoin playbook is Sequans, a French semiconductor firm trading on the New York Stock Exchange under the symbol SQNS. They just announced the addition of 3 Bitcoin to their treasury, bringing their total to 1,053. That vaults them into the exclusive 1,000 Bitcoin club of public companies, landing at number 31 on the list of largest holders. Their stated goal is to climb much higher, and they're partnering with Swan Bitcoin to make it happen. And they're not alone. Across the board, the Bitcoin ETF inflows are relentless, stacking coins every single day. Put those flows together with corporate treasuries and the supply shock is obvious. Right now, there are only 450 new Bitcoin mined every day. Corporations like Strategy are absorbing weeks of supply in a single purchase. That's why the market feels different this time. This is exactly why Saylor stated we have seen the end of Bitcoin winters. Take a look at this clip.
Winter's not coming back. We're past that. We're past that phase. If Bitcoin's not going to zero, it's going to $1 million. And you have all the evidence you need to determine that, right? The President of the United States has determined he supports Bitcoin. The cabinet supports Bitcoin. Scott Bessent supports Bitcoin. Paul Atkins has shown himself to be an enthusiastic believer of Bitcoin and digital assets. Ken Tez at CFTC feels the same way. The banks are going to custody Bitcoin. Bitcoin has gotten through its riskiest period.
Corporate treasuries have already set the pace for this run, but the conviction from the biggest names in the space adds even more weight. Saylor, the man who pioneered the Bitcoin treasury model, now believes the days of Bitcoin winters are over. The days of brutal 80% drawdowns followed by years of waiting are a relic of the past. For more than a decade, Bitcoin fought uphill battles against regulators, unclear accounting rules, and skepticism from traditional finance. Those risks aren't gone entirely, but the most dangerous period is behind us. The president has openly supported Bitcoin, federal agencies have approved ETFs, and major banks are rolling out custody. At the same time, ever since the 2024 Bitcoin halving, daily new supply has collapsed. Only about 450 coins are mined each day, or roughly $50 million worth at current prices. That's a fraction of the demand coming from ETFs and corporations. The supply available on the open market is shrinking so fast that buyers are competing against each other, not against miners. Saylor's point is that the market structure itself has changed. In earlier cycles, supply overwhelmed thin demand and sent prices into freefall. Now, demand overwhelms supply at every level, forcing prices to climb until it shakes out new sellers. At an all-time high of $112,000, it only takes a few institutional allocations to move the entire market much higher. In his words, if Bitcoin isn't going to zero, then it's going to a million. And as bold as that sounds, Saylor's conviction is now spilling over to other institutional investors who are beginning to realize they've been on the wrong side of history. After Saylor's bold call, it's pretty clear how different this cycle looks compared to the past. And if there's one voice that unintentionally proves it, it's Dave Portnoy. The Barstool Sports founder has been in and out of crypto for years, often jumping in at the wrong time and exiting in frustration. But his latest comments hit a nerve because they capture the regret countless retail investors are starting to feel. On his own show, he admitted that he should have just bought Bitcoin and held. It's the same realization creeping up on countless retail investors as Bitcoin blasts past 6 figures.
Holy shit. I fucked myself so hard. Goddamn, I fucked myself with Bitcoin. It's just one of those things that I just fucked myself with. I'll never get over what I've done with Bitcoin. Just a total debacle. I have fucked myself so hard with Bitcoin. Barstool should have owned Bitcoin. The second I got Barstool back, I should have bought like 10 million of Bitcoin. I'm so mad at myself about Bitcoin. I should be up like 75% in Bitcoin. I should be up 750 grand in Bitcoin instead of down. Fuck Dave.
When you zoom out, the math makes the case. Since 2012, the S&P 500 has collapsed nearly 100% when priced in Bitcoin. Gold, long seen as the hard money hedge, has lost nearly all ground against it as well. Even the high-flying Nasdaq looks weak in comparison. Bitcoin keeps going up because unlike dollars or stocks, nobody can print more of it. For Portnoy, the comparison feels absurd. Years of stock trades and speculation look pointless when Bitcoin keeps outrunning everything. But what Portnoy doesn't grasp is that Bitcoin is not simply another investment, it's better money. Stocks, bonds, and commodities all measure their performance in fiat terms, and fiat continues to bleed value every year. It doesn't need earnings reports or dividends. Its power comes from scarcity and adoption. That's why regret is spreading quickly. Those who waited for clarity or a perfect entry are now realizing that inaction cost them more than any bad trade. And this regret is only going to grow as price discovery continues higher. The scale of this is what Saifedean has been warning about for years. While Portnoy's frustration captures the retail experience, Saifedean Ammous takes it a step further and explains why the disbelief keeps repeating. The economist behind the Bitcoin standard has argued for years that Bitcoin cannot be compared to stocks or commodities because its market is money itself. Apple's growth is capped by how many iPhones it can sell. Amazon's value is tied to commerce, but Bitcoin's growth is limited only by how much global capital is searching for a monetary home. That target market is not a few trillion, it's $200 to $300 trillion across cash, bonds, and gold. At the moment, Bitcoin holds only a fraction of that. The gap between where it sits now and where it can go is enormous. Ammous also dismantles the argument that Bitcoin's lack of cash flow makes it a Ponzi. Gold never paid dividends, yet it dominated global money for centuries because it held value across time. Bitcoin improves on gold's qualities in every dimension: scarcity, portability, verifiability. The more it proves itself, the more capital shifts its way. Every leg higher becomes proof of concept that accelerates the next round of adoption. This is why what looks expensive in the moment often looks cheap in hindsight. Each run validates a thesis and pulls in deeper pools of money. For retail investors, this perspective matters because it explains why hesitation always turns into regret. They're judging Bitcoin through the lens of traditional assets when the real comparison is monetary history itself. Ammous frames it as a once-in-history monetization event. And if that is correct, then we are still in the early chapters. The data backs it up too, with Onchain metrics showing this cycle is nowhere near overheated. Ammous notes the scale of Bitcoin's market, but the charts measure of where we stand. The MVRVZ score compares Bitcoin's current price to its realized value, which is the average cost basis of all coins in circulation. In earlier cycles, this metric pushed above 7 during periods of mania, and that's where major tops formed. Today, the reading is only between 2 and 3. That level reflects a healthy mid-cycle zone rather than a euphoric peak. It is the same range where past runs delivered their strongest price advances. At this stage, even if Bitcoin only meets the strength of the last cycle, the target sits near $1,000. If adoption pressure exceeds that, the projected range extends past $200,000 and could climb toward $300,000. Other long-range valuation channels confirm this outlook, with Bitcoin still trading in the lower half of its multi-year trajectory. Every cycle on record has eventually forced a breakout into higher territory, and not a single one has ended while prices remained at current levels. This matters because critics point to the chart and call $124,000 overheated, but the data says otherwise. Mid-cycle has historically produced the steepest climbs, not exhaustion. That means the current setup could carry far more upside before any lasting top forms. Combine that with ETF inflows and the steady march of corporate adoption, and the conclusion is clear. Price is not stretched to its limit, it's building pressure for the next move. The question now shifts to the corporations and institutions that have not yet stepped in, because their arrival will collide with an already scarce supply. On-chain signals show Bitcoin has room to climb, but the real powder keg sits with the institutions that haven't entered yet. Saifedean of Swan has been clear about this. He points out that the most ambitious corporate Bitcoin buyers are still waiting. Firms like 21 Capital, backed by Tether and SoftBank, or David Bailey's Nakamoto acquisition vehicle, are preparing infrastructure, waiting for audits, and moving through compliance hurdles. None of them have pushed the buy button yet. When they do, it won't be a few million. There will be billions flowing into a market with daily issuance at less than 500 coins. Sequans, the semiconductor company we mentioned earlier, is only a taste of what's coming. They managed to leap ahead by raising capital through an already listed vehicle on the New York Stock Exchange. That allowed them to move quickly, buy Bitcoin, and secure their place among the largest public holders. Other corporations don't have that luxury. Many are stuck waiting on paperwork, mergers, or de-SPAC processes. But once cleared, they'll begin buying, and the volumes will dwarf what we've seen so far. This stage of the cycle is unusual because the early corporate players have already absorbed natural supply. Saylor pointed out that treasuries and ETFs together are buying far more than miners' supply. That means the next wave of companies will be forced to compete against each other in order to secure allocations. Unlike retail speculation, this demand doesn't evaporate overnight. Corporate buying is sticky. Balance sheet allocations are not reversed on a whim, which is why this moment looks like a speculative bubble and more like the start of a long structural repricing. And that's what Parker Lewis described years ago as the suddenly phase. Here, the pieces are now in place for what Bitcoiner Parker Lewis described years ago as the gradually then suddenly moment. Adoption has built slowly over time, with miners, early retail, and a few visionaries carrying the torch. Then came institutions, ETFs, and the first wave of corporate treasuries. That was the gradual part. The suddenly part begins when new supply can no longer meet demand and the market is forced to reprice violently higher. With an all-time high of $124,000, we are already testing that dynamic. Sellers at this level are being exhausted. When they are gone, the next price level is found only by moving sharply upward to locate new supply. This is why the cycle feels different. In retail speculation drove rallies that could be shaken out with sharp corrections. This time, the dominant buyers are corporations, ETFs, and institutional allocators. These flows don't vanish overnight. They are structured, deliberate, and sticky. That makes every dip shallow and every rally stronger. With each step higher, confidence grows, and hesitation from new buyers turns into panic to secure allocations. That reflexive loop is the essence of the suddenly phase. It's also important to remember what happened yet. The Federal Reserve has not cut rates. Liquidity conditions remain tight compared to what they could be in the coming months. If a rate-cutting cycle begins while Bitcoin is already pressing against supply constraints, the move higher could be faster and more explosive than anything seen in prior cycles. Parker Lewis framed it as an inevitability. Gradual adoption builds the base, then suddenly the market wakes up to scarcity and the repricing happens all at once. The signals suggest we are approaching that moment. And that brings us to the idea of this being more than just another bull run. It looks like a generational shift. Everything we've covered leads to one conclusion. This is not a repeat of 2017 or 21. The current move has a structural weight those cycles never had. ETFs are creating constant demand, buying more than miners produce each day. Corporate treasuries are scaling strategies that permanently remove coins from circulation. Nation states are preparing their entry, recognizing that exposure to Bitcoin is no longer optional for long-term stability. On-chain metrics confirm we are far from overheated conditions. Even more telling, some of the largest planned buyers have not started purchasing. When they do, they will enter a market where available supply is already razor thin. This is why analysts describe the moment as generational. A single cycle can create life-changing returns, but what we are witnessing looks bigger than a cycle. It looks like the repricing of Bitcoin from a trillion-dollar asset to the foundation of a multi-trillion-dollar system. Every participant in the economy, from corporations to governments, will eventually need to decide whether to hold Bitcoin. That demand horizon stretches decades, not months, yet the supply remains fixed at 21 million coins. The outcome is not hard to project. Price will adjust upward until equilibrium is found, and every step closer to that equilibrium leaves fewer opportunities for late entrants. At an all-time high of $124,000, skeptics say the move has already gone too far. The data and the flows suggest the opposite. What feels expensive today may look like the cheap entry of a lifetime in hindsight. The gradual build-up has carried us this far. Now, the suddenly phase, the point where years of slow adoption flip into rapid repricing, is close. When it hits, it can shock even the most seasoned investors. This is, we believe, the generational Bitcoin price run is already underway, and also why it's more important than ever to stay ahead of the curve. So if you want to stay ahead of these signals and know exactly when the market's heating up or when it's giving you those rare buying windows, I break it down every day in the Crypto Nutshell, my free 5-minute daily crypto newsletter. It's built to give you quick, actionable insights so you can make smarter decisions without spending hours buried in charts or headlines. You'll get clear signals on when to buy, when to take profits, and the latest news that could move markets, all delivered straight to your inbox. Just click the first link in the description, enter your email, and you're in. Anyway guys, that's all we have for today. Thanks for watching, and I'll see you all in the next video.